want to turn it back to the jobs report and bring in our next guest. David Dodson is a Stanford University Business Professor. Professor, thanks so much for joining us today. And just want to get your reaction to that jobs report. The number was big, 678,000 jobs added to the U.S. payrolls. The estimate was for 422,000, unemployment dipping to 3.8%. What are your big takeaways?
Well, let's sort of break it down, and let's start with taking the Russian invasion of Ukraine and put it to the side just for a second. So what does that number of jobs mean? Well, I think it's good to sort of imagine you work for a company that has 250 employees. That meant they added one job. So it's better than losing a job, and it's better than no jobs, but it's not sort of a remarkable change in the US economy if you think of it in the context of a company like that. To me, the number of jobs that were added was pretty consistent with what we've been seeing in this post-pandemic world where people are returning to work, where employers are trying to meet consumer demand. It was no big surprise to me. And the difference between 400,000 and 600,000 on 150 million person workforce isn't really actually that big of a number. The second thing I would think about. Yeah.
Mm-hmm. Yes, go ahead. Go ahead.
Yeah. The second thing I would think about is the unemployment rate. And so, we're definitely at full employment. Everybody who, if you think about full employment is kind of in the 2 to 4 range, you could argue that everybody who wants a job can get a job. Now, when you think about the unemployment rate coming down, you have to think about two things: the number of jobs that are being added, which we just talked about. But there's another part too, which is the number of people who are looking for a job. And that's what's captured in the unemployment rate. And we've got kind of a remarkable thing happening now, which is the worker participation rate is down 4% compared to where it was pre-pandemic. A lot of people have retired. 1% more of the population is retired now than it was before. So we've got this kind of heated economy or semi-heated economy and fewer people to go take those jobs.
Okay, and then so I also want to ask you what you make of the hourly wages rate, because they were flat on the month, up 5.1% year over year. What signal does that send? And then how much is that hurting, consumers where real wages are actually negative and we see these prices going astronomical at the moment?
Yeah, it is curious, isn't it? What's interesting is that there's two parts to the inflation. One is sort of we know what historical inflation is, and it's really high. But there's a second number, which is what consumers are anticipating inflation to be. And why that's so important is because consumers' anticipation of inflation can be a self-fulfilling prophecy. And curiously enough, consumers' expected inflation rate over the next 5 years is only about 3%, which is just a little bit higher than the Fed's target of 2%. So American consumers are sort of saying, yeah, prices are cranking up because people are going to work and we have a lot of money and there's some pent up demand, but we think it's going to settle back down. However, remember, I started this by saying we have taken sort of the Russian invasion of Ukraine and put it to the side. Well, oh boy, that none of that is captured in these numbers.
Yeah, absolutely. There is a great deal of uncertainty over what happens in Ukraine and if there is an escalation in tensions there. So I'm wondering, how does the Fed take the report that we saw? How much does it propel it on its course that it's laser focused on reining in high inflation amid this uncertainty that's going on? No one exactly knows which way it's going to go.
Yeah, so the Fed is supposed to work on two things: one, unemployment, and inflation. Well, unemployment's fine. There's nothing for them to do there. So now they need to shift their focus on inflation, and clearly we have the potential for an inflationary environment, not just because of what we've already experienced before Russia's invasion into Ukraine, but also now you've got, because of this invasion, now you've got almost certainty that energy prices are going to go up and other commodities are going to be more expensive because Russia provides a lot of wheat and Russia provides a lot of gas and oil. And all of that is going to sort of ripple through the economy. Plus, when you have disruptions in the supply chain, like we've already had, and now you had Russia and China disrupting that supply chain, costs are going to go up. So Fed is going to have to raise interest rates, and they've said they're going to raise interest rates. And we sort of knew that. The second thing is that to get through the pandemic, everybody has to remember that the Fed artificially dropped interest rates very, very low because they wanted to sort of assist the economy through the pandemic. Well, we're largely through the pandemic, so it is time for the Fed to get the rates up to sort of normal interest rates that we would expect, where there's actually a price to the cost of capital. We've spent, pretty much the last couple of years where capital has been free.
Okay, and we do have the president set to speak shortly, so I may interrupt the next question, so bear with me. I apologize if I need to cut you short. But then how worried are you that the Fed doesn't achieve a soft landing? Powell said that is possible. And then what are your fears that a recession is on the horizon?
First of all, you can interrupt me for the President of the United States. That's okay. I think that the Fed has done a really good job, a remarkable job of signaling in advance of what they're going to do and doing it very gradually. So they are just adjusting the knob a little bit at a time, and they're telling us in advance they're going to adjust the knob a little bit at a time. That's an extraordinarily safe way to manage it. And so I don't expect the Fed to be doing any major disruptions in the economy. I'm more worried about, what's happening in the Ukraine than I would anything that the Fed would do.
And then tied to that, we're seeing oil and commodities soar. What sort of oil price are you looking at that could, make you sort of rethink where we are and that a recession is on the horizon?
Well, I don't think that the disruption to the energy markets is going to be medium or long term. We're going to make adjustments to that in the medium term. Obviously, when you affect the flow of natural gas and oil out of a country that supplies as much as Russia does, you're going to have an immediate pop. But Russia's, for example, Europe's liquid natural gas or LNG capacity is only at about 50%. So they have an opportunity to shift from Russia to other sources of natural gas. We also have a lot of places in the world that are not at capacity. The Middle East is not producing at capacity. So we're going to make those adjustments over time, and prices are going to come back down. We're just going to have to swallow hard for a while. I mean, let's face it, Europe's at war, and we can't have a war going on in Europe and expect, we want gas prices to be exactly the same. We're going to have to feel some pain, and we're going to have to feel some effect of that.
All right, we will leave it there. Thank you so much for your perspective, David Dodson, Stanford University Business Professor.